How many are familiar with the term EBITDA? Used a lot, right? So this is the number that's used most often in transactions to determine what the operating cash flows of the business are, okay? Anybody have a different definition of it that's done these? You use EBITDA a lot when you were looking at transactions. So what, if you think about it, it's the earnings before interest, taxes, depreciation, amortization. So let's do the easy part first. It doesn't include depreciation and amortization, which are what kind of costs? Non-cash, right? Those are in your earnings, but they aren't really cash, right? So we don't want to count those. Taxes aren't counted because third parties looking at companies have their own tax structure, right? That are in, like you could have two companies with different tax structures that could affect, if you counted the other person's structure as yours, it could affect your return. So taxes come out of the formula because they can confuse the result. And then before interest, so that takes the cost of capital of your debt out of it so that it gets you to a cash flow that doesn't have a financing cost associated with it. So when you add back interest, taxes, depreciation, you're looking at operating cash flows of the business that are real cash flows that are unaffected by however you've decided to use debt, however levered you've decided to use it. So it gets you to the cash that the assets of the business generate, okay, uninfluenced by whether you have a lot of borrowings or too little borrowings. Because remember, when we get the equity value later, we're going to take the debt out anyway. Everybody with me? Why that matters? So this is the term that is used when people say cash flows. In the real world, they're looking at this measure with some adjustments. And we'll talk about the adjustments, then we come back, we're going to do a quick exercise. Ultimately, what you're trying to do, even when you model this for yourself, is to get to what's called adjusted EBITDA. Non-operating items. So what you're trying to figure out is what the recurring cash flows are, okay? If you had a year where you had a legal settlement in your favor or against you, remember that chart I said with when you're in the middle and you got the forward years and you got the years behind you? The dilemma is trying to figure out what the two words, predictable and sustainable cash flows are. So when you try to analyze it, you got to take out stuff that doesn't recur, that's non-operating. Because lawsuits don't happen every year in your favor or against you. Casualty losses, those kinds of things. Okay? So you got to adjust for those. Unusual, non-recurring. Adjust for the fair market value items related to private ownership. Okay? There could be a lot in this bucket. The kids are on the payroll for the summer. You get to the end of the year and profits, I've paid myself, I'm going to be the make-believe CEO. CEO's pay for a company like mine and my size is $500,000. We had a great year. We made $1.5 million. I gave myself $1 million bonus. Is that an economic cash flow if you're looking at the value of your company? No, because a third party wouldn't pay you the $1 million. They'd pay you fair market value pay to be the CEO. Right? So you adjust for fair market value of items related to private ownership. So if you're in a business and the business is not doing well and it sort of doesn't perform, and you're paying yourself a salary as the CEO of $70,000, and normal CEOs pay for a company of your size, which, by the way, there's easy ways to get access to that. We could help you if you wanted to know that stuff. But if normal CEOs pay is $200,000, you have an economic deduction from the real cash flows. Because remember, if you look at it separately, you separate yourself from it. You would say, if I looked at it truly as an investor, the role of the CEO is going to cost me $250,000. This person's only paying themselves $70,000. I got to deduct some more money against the cash flows to really look at it the right way. You with me? I'm trying to get you to think about this as an investment. Think about the stuff that's non-economic to try to get to those cash flows. So you could have stuff moving in either direction, and I have examples over years of doing this that's the case. I have some companies that people forego their salaries or significantly reduce them because it doesn't perform. But if you want to really get to the fact of trying to improve the value, you can't start with a faulty number, is what I'm saying. You got to do your best. Now, would I take, all these things related to private ownership and have them all over the place? No, right? I would be modest about how this would be a calculation that I would do, with the owners of the business. But that stuff exists, to my experience, in almost every company to some degree, right? It just does. And this isn't an exercise in precision necessarily. You got to get your arms around the big pieces of it. Because remember, all you're trying to do is to get to know what the real cash flows are. And then the last item, CapEx, which means capital expenditures. So remember that you're adding back depreciation up here because it's non-cash. You've got to look at how your capital expenditures correlate to that, and you should take a deduction for money that's, money that you're spending to replenish your equipment's got to be deducted, right? You can't add back the soft costs up here without, if you have a claim on your capital to buy equipment all the time and it's a real cost of cash, you got to count it. You got to take it off when you're trying to get to a real cash flow number.